Good evening, and welcome. Tonight, we delve into the complex history of trade relations between the United States and China. Our story begins in the 1970s, a time of significant change on the world stage. After decades of minimal contact, the United States and China began taking steps towards normalized relations. This thaw in relations was spurred by geopolitical factors, including shared concerns about the Soviet Union. In 1972, President Richard Nixon made a historic visit to China, marking a turning point in United States-China relations. This visit paved the way for increased diplomatic engagement and, crucially, the beginning of trade between the two nations. American businesses saw a vast, untapped market in China, while China was eager for access to American technology and goods. The late 1970s saw the formal establishment of diplomatic relations between the United States and China in 1979. This move solidified the growing economic ties between the two countries. The stage was set for a new era of trade, one that would see China emerge as a global economic powerhouse. Over the next 2 decades, trade between the United States and China would grow exponentially, laying the groundwork for the complex economic relationship we see today. The year 2001 marked another significant milestone in United States-China trade relations, China's accession to the World Trade Organization. The WTO is a global organization that regulates international trade and promotes free trade among its members. China's entry into the WTO was a complex and lengthy process, signifying its commitment to integrating into the global trading system. Joining the WTO came with specific obligations for China, including reducing barriers to foreign goods and services. This led to significantly lower tariffs on Chinese imports to the United States. Before 2018, the average United States tariff rate on Chinese goods was around 3.1%. This era of low tariffs facilitated a surge in trade between the two countries. American consumers benefited from lower prices on a wide range of goods, from clothing and electronics to furniture and appliances. China's manufacturing sector boomed, fueled by access to the massive American consumer market. This period of economic interdependence seemed to solidify a mutually beneficial relationship between the two nations. However, underlying tensions regarding trade imbalances, intellectual property rights, and China's economic policies began to simmer beneath the surface. These tensions would eventually boil over, leading to a dramatic shift in United States-China trade relations. In 2018, the United States-China trade relationship took a sharp turn with the election of Donald Trump. President Trump had long been critical of China's trade practices, accusing Beijing of unfair competition, intellectual property theft, and currency manipulation. He argued that these practices were harming American businesses and workers. Determined to rebalance the trade relationship in favor of the United States, President Trump imposed tariffs on billions of dollars worth of Chinese goods. These tariffs, essentially taxes on imported goods, were designed to make Chinese products more expensive for American consumers, thereby encouraging them to buy American-made goods. The initial tariffs targeted specific sectors such as steel and aluminum. However, they quickly escalated to encompass a wide range of products. By 2019, the United States had imposed a 25% tariff on approximately $250 billion worth of Chinese goods, significantly impacting bilateral trade. The average tariff rate on Chinese imports rose to 19.3%. A dramatic increase from the pre-2018 level of 3.1%. These actions marked the beginning of what became known as the United States-China trade war. China retaliated with its own tariffs on American goods, targeting key exports like soybeans and automobiles. The trade war had begun, casting a shadow of uncertainty over the global economy. The year 2020 saw a change in the White House, with Joe Biden succeeding Donald Trump as President of the United States. Many anticipated a shift in United States policy towards China, including a potential easing of trade tensions. However, the Biden administration largely maintained the tariffs imposed by the previous administration. President Biden argued that the tariffs provided leverage in negotiations with China, and that removing them prematurely would weaken the United States' position. While the Biden administration did reinstate some tariff exclusions, allowing certain products to enter the United States tariff-free, the overall approach to trade with China remained largely unchanged. Trade tensions persisted, with both sides engaging in diplomatic talks and economic maneuvering. The Biden administration focused on working with allies to address concerns about China's economic practices, forming a united front to pressure Beijing on issues such as intellectual property rights and forced technology transfer. Despite these efforts, the underlying trade tensions remained unresolved, setting the stage for further escalation upon Trump's return to the presidency. In a surprising turn of events, Donald Trump returned to the White House in 2025, winning a second term as President of the United States. This change in leadership had immediate repercussions for U.S.-China trade relations, as President Trump wasted no time in resuming his confrontational approach towards Beijing. In February 2025, just weeks after taking office, President Trump reinstated a 10% tariff on all Chinese imports, a move that sent shockwaves through global markets. This initial tariff increase was followed by another 10% hike in March, bringing the total tariff on Chinese goods to 20%. The Trump administration justified these actions by claiming that China had not made sufficient progress in addressing the concerns raised during the previous trade war. The return of tariffs marked a significant escalation of the trade war, signaling a return to the confrontational approach that characterized Trump's first term. These actions had immediate consequences for businesses and consumers on both sides of the Pacific, as the cost of goods began to rise and uncertainty gripped global supply chains. China wasted no time in responding to the Trump administration's renewed tariff offensive. Beijing viewed the United States' actions as a provocation and a threat to its economic interests, prompting swift and decisive countermeasures. In a tit-for-tat response, China imposed its own tariffs on a wide range of American goods, targeting key exports like agricultural products, automobiles, and machinery. These retaliatory tariffs, set at 34%, were designed to inflict economic pain on American businesses and pressure the Trump administration to reconsider its actions. However, China's response went beyond tariffs. Beijing also took aim at a key strategic resource: rare earth elements. These elements are crucial for a variety of high-tech industries, including electronics, renewable energy, and defense. China is the world's largest producer of rare earth elements, controlling a significant portion of global supply. By threatening to restrict exports of these critical materials, China sought to leverage its dominance in this sector to gain an advantage in the trade war. This move sent shockwaves through global supply chains, as companies reliant on rare earth elements scrambled to secure alternative sources. The trade war had entered a new, more dangerous phase, characterized by tit-for-tat retaliation and the increasing weaponization of trade. As the United States-China trade war raged on, both sides implemented targeted exemptions, offering a glimmer of hope amidst the escalating tensions. These exemptions, while limited in scope, provided some relief to specific industries and highlighted the intricate web of economic interdependence between the two nations. The United States government, recognizing the potential negative impact of high tariffs on American consumers, excluded certain consumer electronics from the highest tariff rates. Products like smartphones, laptops, and video game consoles, often assembled in China using components from around the world, were spared the full brunt of the trade war. This exemption aimed to mitigate the impact on American consumers who had grown accustomed to relatively inexpensive electronics. On the Chinese side, exemptions focused on products deemed essential for domestic consumption or critical for key industries. Pharmaceuticals, certain aerospace parts, and specific types of microchips were among the items granted tariff relief. These exemptions reflect the delicate balancing act both countries faced, inflicting economic pain on the other while safeguarding their own economic interests. The exemptions, while offering a respite from the trade war's full force, did little to address the underlying issues driving the conflict. The escalating trade war between the United States and China sent ripples throughout the global economy, impacting businesses, consumers, and financial markets worldwide. The interconnected nature of global supply chains meant that tariffs imposed by these economic giants had far-reaching consequences. Businesses on both sides of the Pacific felt the pain, as tariffs increased costs, disrupted supply chains, and created uncertainty. Chinese factories, facing decreased demand from the United States market, halted production and laid off workers. Some sought new markets for their goods, turning to Southeast Asia, Africa, and Latin America. Others pivoted to focus on domestic consumption, fueled by China's growing middle class and the rise of e-commerce. In the United States, businesses faced higher costs for imported components and raw materials, leading to price increases for consumers. The trade war fueled uncertainty in global markets, leading to volatility and fluctuations in stock prices. Investors concerned about the long-term economic impact of the trade dispute shifted their investments, seeking safer havens for their capital. The International Monetary Fund downgraded its global growth forecast, citing the trade war as a major contributing factor. The economic conflict between the world's two largest economies cast a long shadow, threatening to undermine global economic stability. As of April 2025, the United States-China trade war continues, with both sides entrenched in their positions. United States tariffs on Chinese goods remain at historically high levels, reaching up to 145% on certain products. China, in turn, has retaliated with its own tariffs, reaching 125% on a range of American goods. Despite the ongoing tensions, both sides have engaged in cautious dialogue, recognizing the potential for mutually assured economic damage. Negotiating teams have exchanged lists of goods for potential tariff exemptions, seeking to find common ground and de-escalate the conflict. However, deep mistrust and fundamental disagreements on trade practices, intellectual property rights, and China's economic model continue to hinder progress. The future of United States-China trade relations hangs in the balance. Will the two economic giants find a way to resolve their differences and forge a new, more balanced trade relationship? Or will the trade war continue to escalate, further fragmenting the global economy and fueling geopolitical tensions? The answers to these questions remain uncertain. The stakes are high, not only for the United States and China, but for the entire world. The outcome of this trade war will have profound and lasting consequences for the global economy and the future of international relations.